Everyone knows we have a housing shortage in Los Angeles.
LA has some new proposals to tackle the city's affordable housing crisis.
California is the pain in the ass to build. Change of zoning in LA
It's almost impossible to develop right now in today's market.
interest payment that you're paying, property taxes that you're paying, and you're seeing no cash flow.
You can't give me the land for free and I won't develop it. Why are they saying that?
So the interest just shot up like crazy. So now each month you're paying double what you anticipated that you would be paying. Everyone always asks me,
Yeah,
how much is it to build? I brought some notes.
I want to know.
This will answer your question.
Welcome to No Vacancy, where I share conversations with LA's top multifamily owners, investors, and visionaries. I'm your host, Taylor Avakian, the founder of the Group CRE, and I specialize in the sale of apartment buildings in Los Angeles. On this show, we cut straight to what matters, market insights and real-world strategies straight from LA's multifamily icons to help you navigate one of the most complex real estate markets in the world, Southern California. Enjoy. Welcome to the podcast. Host Taylor Avakian. I'm here with a very good friend and guest today, Paul Schon. Paul, let's start it off with why are you sitting in this chair today?
Sure. I'm in real estate in Los Angeles. I'm more of a developer, but also an investor. I build multifamily projects across LA. My company's Schon Development Group, and we started as developers and in the multifamily space, and now we do it all. We invest, we're a general contractor, we're a property manager, and that's the business.
I love it. How did you get started in development?
I started my real estate career brokering. So I was telling you, I was Mark Similich brokering in the worst time ever.
Funny, man. But dude, Pete, we were talking about earlier, Pete started as a broker. That's why he told me, he said, because I wanted to be a developer. And he's like, go be a broker first, learn the business. Once you make the connections, once you understand everything, what's a good deal, what's a not, you know, like where to get financing and all that stuff, then you can go be a developer. So like, did you have that in the back of your mind when you started broker?
Similar. So my dad, who's been an awesome mentor for me, the inspiration for me, I told him, I want to be a business owner. This was in college. How do I be a business owner? And he said, go work for a company, learn the business, and then you can go off and start your own thing. And I noticed my friend, this is pre the Great Recession, making a lot of money selling industrial at Mark Similich in San Diego. And I'm like, okay, he's making a lot of money. So I started brokering to really understand the business. And Mark Similich gives you a great education. So started the career there. In the meantime, I met my old previous business partner, and he had just moved to LA. And while I was brokering, we were flipping homes on the side because 2009, 2010, everything was for sale. So we just started buying houses, initially doing remodels, kitchen, bathroom remodels, flooring, paint, sell, and flipping them really fast. And then we started doing additions to homes. So learned how to talk to architects, engineers, then started doing bigger additions to homes because the margins started getting really squeezed for just a regular flip. So we started adding square footage. And then we started building homes. So that's how we got into development. So from flipping to doing additions to building homes ground up, built a couple duplexes. And then, so that was 2009, 2010. We scaled it. We were doing like 15 homes at a time. So we start going in South Central, the Valley, got some good pockets in the areas, got some West Hollywood, Hancock Park, that we're just doing volume, Gardena, Hawthorne, Westchester, all over the place. And then we bought some land in 2012 to build our first building. And we built our first building, and we're like, oh, we like this better. Because we were making good money, but it's ordinary income. We were just paying lots in taxes. And we're like, all right, let's get into, but it was awesome. We learned how to deal with it, architects, engineers. We learned how to do construction in-house. And we really understood the construction. And when we felt like we could do our first apartment building, it was honestly easier because you're dealing with good subcontractors and good architects and engineers. So that's how we pivoted to apartment buildings.
That's super interesting because it's like, it's the age-old story of, right? You start small and then you learn a little bit and then you pivot and then an opportunity comes. You're like, yeah, it's risky, but I mean, we know how to do this. Like, what's a 20-unit apartment building versus extra bedroom? I mean, it obviously on the surface, on paper, it sounds crazy, but I think when you're in the process, it's just like why managing, and you know this too, managing an 8-unit apartment versus a 100-unit apartment. At a certain level, it's kind of easier to do and to make money on a 100-unit apartment and scale than have 50 8-unit buildings scattered across the entire city.
Oh, yeah, for sure. And that's what we have. We have a bunch of smaller buildings across the city. So our property managers, they're running around the city all over the place, versus if it's all in one, it's easier, more efficient to manage. But we think there's more of opportunity in the middle market space. So I like staying in the 20 to 40 unit range.
Why do you say that? Why do you think there's more opportunity in the middle market?
I think it's just the sellers are not as
you could say sophisticated, because it's true.
They're not as sophisticated. They maybe own the apartments for a long time. They haven't juiced up the rents. They haven't remodeled. Versus the institutional owners, they're squeezing for everything. So,
well, which brings me to another point, and then we'll hop back into a little bit about Mexico, because if Paul is Mexican, which yeah,
proud of it too.
Yeah, exactly. So it's almost impossible to develop right now in today's market. Why do I keep hearing that from every developer? They're like, you can't give me the land for free and I won't develop it. Why are they saying that?
100% accurate. We've seen costs. There's many factors, but costs have increased so much, rates have increased so much, and times to build have increased so much, so not only did your rates go up, but now instead of a 15-month build, 18-month build, it's taking 2 years, 2.5 years, sometimes even 3 years. So imagine that interest payment that you're paying, property taxes that you're paying, and you're seeing no cash flow. So I wanted to bring some, because everyone always asks me, how much is it to build? How much is it to build? So the main question that I get asked, we built 30 buildings across LA. So I brought some notes, and this will answer your question.
Okay, I want to know.
So this is 10 years ago or 12 years ago. We built a building. And then we built the building 12 years later. Same exact building.
Okay, so start me from like finding the deal and closing on the deal to like give me the timeline.
This was like we built it in 2014 or 20 around there, and then we built a very similar building in 22. So very like 10 years or so across it has passed. So land. Originally, we bought it for $40 a buildable square foot. And now that land, even though land prices have come down, it's double, $80, $90 per buildable square foot. Soft costs have increased. The city has added more soft costs. The professionals are charging more. So soft costs were $19 a foot for that building. Now they're around $50 a foot.
Holy.
Yeah, so that's more than double. Hard costs. This is where the majority of the money is in the hard costs. $170 a foot. We built it per gross square foot. Now you're at around $350 a gross square foot.
And it's for the same kind of
exact building. So literally, we grabbed this because we would repeat a lot of the same buildings, similar lots, same architect, same design, same everything. So hard costs would more than doubled. And then financing costs, that's where it's, even now with today's rates, we paid around $15 a foot on financing. Now it's close to $50 a foot. So we were building for around $250 a foot, all in, including land. Now to build that building, you're at the mid 500.
And you can't sell a building for that.
Exactly. So right now we're in escrow to buy a building around $420 a foot to buy. And this is newer construction. So that's why development doesn't make sense. So I took some notes because I wanted to make sure I give you
super helpful.
Good accurate numbers.
Super helpful because. So why do you think on some of the things like obviously soft costs, because the city and the attorneys and planners and all that stuff, they're more expensive, sure. Like more because it's from time of land acquisition until you're actually doing stuff coming out of the ground is what, a year, two for entitlements?
At least a year. So we used to be able to, the same thing. It's like things just take longer. When there wasn't that much development going on, we could get from acquisition to breaking ground in 12 months. Now it's even, and this is by right stuff or TOC stuff, even ED1 stuff. We got one ED1 going right now. It's taking 18 months. Yeah, around 18 months. So
just to get out of the ground.
And
people in Texas or any other of these other states, which I know you guys were trying to work on some in Texas, like there's like no zoning in Houston. So yeah, I mean, what does it take to build something in Houston? Like a year?
I don't know. I bet I hear it's way faster. And then when I go to national conferences, we're always the laughing duck in California. It's like, what are you guys even doing over there? You guys have the worst housing crisis, and it takes you guys the longest. You guys have I don't know if we have the biggest fees to build, but I would assume so. Plus, it's like, yeah, California is just a pain in the ass to build.
And they keep saying we have a housing shortage, and it seems like they're not doing very much to make that easier for developers like you. I sound like a broken record because I say it almost every time, but everyone knows we have a housing shortage in Los Angeles. Why do the rents keep coming up? Because supply and demand. That is the fundamentals of why your rent keeps going up. It's because there's not enough housing for everyone else. And when it's harder to develop, that only constrains the supply, where it becomes almost a benefit, or like the people who are winning are the ones who can afford to do these new developments and make it pencil, because their rents are getting almost shielded from the rent control laws and the lack of supply, where it kind of can somewhat financially make sense if at certain periods, right, when interest rates and like things like that are not going crazy. But it just is so hard to build stuff in LA, and people keep complaining that it's, it's the Blackstones of the world. No, we can't build anything. I mean, and you're a testament too to the costs. Even if they wanted to build something, they couldn't build anything because it's too expensive. Jeez, man, that's insane. So you mentioned ED1, which I know we haven't actually talked about a ton, but that was hot for a minute. Tell me why you jumped into ED1. Explain to people what is ED1 and why you guys are doing something like that.
Yeah, I think it's executive directors one. It's the Mayor Karen Bass. I really like this program. When she first got into office, she's like, we're in a housing crisis. We need to build more housing, more affordable housing, which is what we were already leaning towards with building no amenity type buildings, so we can charge a lower price per foot for the renter. And that's where really the demand is in the more affordable space. Everyone can build super luxury, and that's where most of the supply is coming. If you can be in that middle market, it's just tough to be in that middle market. So she passed ED1, and we had a site in Hollywood, good part of Hollywood, near Netflix, near Paramount, where we were going to build a TOC deal. But the numbers didn't make that much sense. We already own the land, so we switched it to an ED1 project. It's still tight, but it makes more sense than a TOC deal. The benefits about ED1 is you get almost unlimited density for that site. So we were going to build 30 some units as a TOC, and now we're building 97 units as an ED1 project. The units become way smaller. So our average unit size is around just over 400 square feet, 1 bedroom units. Most of them are 1 bedrooms, and no parking and no amenities, but washer dryer units, central air. So be nice units. Just you're building, you want to be just under that $2,000 price point. And since it's an efficient construction, because there's no podium, there's no concrete, which concrete for any development is usually the most expensive part, you save in costs. So it pencils better. The unknowns and why I'm only doing one, I haven't bought more land to do more, is what are these going to sell at? So what cap rate? Who knows, because you're deed restricted. So I don't know.
Yeah.
I'll ask you the question.
There hasn't been many that have sold. So it's really, there's not a comp out there?
No one really knows. So you're deed restricted on your rent. So what the exit cap rate's going to be? Who knows? So we don't know that market, but will it rent? And will absolutely rent.
Which is super interesting to me because that's the question. It was super hot because and I'm curious to know. So you said just under 2,000, which is not underwriting towards what a lot of these ED1 developers were doing, which was Section 8 rent. So why did you choose to not underwrite that way? And or are you going to be going after Section 8 renters if, they will rent that space? Because then you get 2407 for one beds right now.
I've leased some Section 8 units with our in-house management company. Sometimes we lease some Section 8 units. It is the leasing velocity we found is not as good as market rate units. I have talked to some leasing agents that specialize in vouchers and Section 8s, and they say they can get good velocity, so we'll see. I just don't want to get too aggressive on my underwriting. Yeah, because Section 8 for that area is 2,400, 2,500, so you get a massive pop if you can do the whole building Section 8, and we'll see. And then I don't know also how intense the management's going to be for Section 8. So we'll see, but that is the potential upside.
And when you are developing these projects, obviously with the homes, you were flipping them and selling them and things like that. Were the apartment buildings that you guys developed and are continuing to develop, is the plan to sell those? Is it to refi? Is it to keep them long-term? Like, what does that structure look like for you guys?
I'll answer that question in a second. One other thing about ED1, which is interesting, is if you partner with a nonprofit and you get some government bonding, you get to reduce or fully remove property taxes, which is huge on your NOI. So that's another benefit.
Which is usually the biggest expense line item.
Yeah, the biggest expense on your operating expenses. So that also can juice up the returns.
And are you partnering on this one?
So they have a 5-year tail, so they don't want you to sell. Speaking of selling, they don't want you to sell for 5 years after you build it. So we're still analyzing. We don't know if we're going to sell the building or hold on to the building. And right now the property taxes is nothing because it's just land. But once it's completed, it'll be a big number. So that's another benefit about ED1. Regarding building and selling, or just buying, doing the value add and selling, or holding on to, I prefer to hold on to stuff. I think that's where real wealth is created, is just holding on long term, getting consistent cash flow, depreciating the asset. But it honestly depends on who our capital partners are. If we have some partners that want to sell, we listen to them, we sell. If we have some capital partners that want to hold on to, we hold on to them. And I think that's where the real wealth.
Interesting. Speaking of capital partners, so we didn't get into your historical background, but basically you were born in Mexico, moved to San Diego, and then made your way up to LA during college or after college.
Yeah, right.
That's what it was.
Yeah, born in Mexico City. When we were 14, my whole family moved to San Diego, and high school, college, first went to UC Davis, then UC San Diego, and then after UC San Diego, I moved to LA, and that's where I started my real estate career. Start building the relationship, telling them what you do. What they like is a lot of people have opportunities to invest in businesses, to invest in crypto. Yeah. It's like there's not a hard asset. Real estate, they can drive by and they can see it and they can touch it and they know that there's going to be some income. So I think that's the trick.
Is how many investors do you typically have on a deal? Like, is it one big capital partner or is it 50?
So most of our buildings have been with a few smaller family offices that we work with, and they just put up 90 to 100% of the equity. We've done a handful of deals where it's syndicated. So we bring in friends and family and friends of friends and brokers who want to put in money in the deal. So most of them, I would say, have been 4 or 5 family offices that we work with. The rest have been syndicated.
Got it. And I think we talked about this before, but you have an interesting model in terms of finding deals. Would you walk me through how you guys initially found the sites and how your, I guess, acquisition model is a little bit different than I think many other developers right now?
Yeah. Well, right now we've slowed down on that. But to find land, we knew exactly, because we're not looking for land right now. It just doesn't make sense to do ground up. So we're looking more for existing. But what we did when we were looking for land, we knew this like 20 square mile radius area that we liked, where we knew the cost, city of LA, so we know how to move through the city. We knew the rents. We knew that the rents would justify the costs. And we would just be dialing for dollars, putting my broker hat on. We had 3 full-time acquisition guys, and we would just call the landowners and say, hey, we're a developer. No offense, but let's skip the middleman.
No, I get it. I get it.
And we'll just buy it from you, save on the commission.
Yeah.
And we just knew what sites we wanted, and that's what we would pick.
Yeah, interesting. And were you calling, because you were a broker in the beginning, were you like, when you first started, you were the one calling?
I was calling, and then I was training our acquisition guys on how to call, so we'd call together. Yeah.
Oh my goodness, man. I mean, it's a great pitch. Like, if you're a seller and you want to sell your land, and a developer comes to your principal and he's like, hey, you don't have to pay 3 to 6%. Like, let's get a deal done. I mean, I would argue that we might be able to get more for your land if you didn't sell direct. But I think from a business model perspective, like, you're shaking the tree. You're making things happen, which, especially when you're starting out and building a company, like, you got to get scrappy. You got to figure out some way to get the ball rolling, get the flywheel going. And that's super cool and interesting.
And we could also pitch the joint venture, which brokers usually don't want to pitch the joint venture because they want to get paid on up front. So we would pitch the joint venture. It's like, hey, you have a lot of built-in equity here. Why don't you just roll it in and we can do a development together? And now it's great because we find the land and we find one of our LPs in the development.
Right. And so then there's less capital that has to come into play and things like that. I'm curious, so back in the day, you obviously knew what you were looking for. What actually makes like a good site for development?
Yeah, so for a developer, that's why you have to be micro-focused, and it's hard to be developing in multiple cities or states or counties. So you got to know the zoning really well. You got to know just what you can build. Like, change of zoning in LA is impossible, and now you have to use some sort of union labor. So we never did that. So we just knew what zoning we could build. We knew what type of density we can afford to build in that site. You got to know how many parking spots you can fit in there. One thing is the turning radius for a parking spot. So you get a very narrow site. Yeah, it might be long and narrow, and in theory you can fit a lot of units, but you can't turn the parking if you're doing parking. So it's like little things like that. If you have an alley, that's huge. If you have a corner lot, that's huge. So there's so many different factors and then we sit with our architects and it's like, first we design the parking. How many parking spots can we fit? Then we design above, because yeah, you might be able to fit a bunch of units, but they're unparked. How much can you rent them for? And then you plug it into a model. You come up with like 5 different designs. You plug them all to the model. You see what makes the most sense. And that's how we end up with a design.
So it's like a sensitivity analysis where you're looking at every single possible option and which one makes the most sense. So speaking of parking, that's been a very hot topic because of ED1. And we spoke with the city. I've been part of this group called ULI. So we've been directly talking to them about this new chip ordinance, which they're changing a lot of the TLC and zoning and stuff in February of next year, which we'll see if that makes any difference. But it seems like they're pushing a lot of new development to minimal, if not zero parking. What do you think? Do you think that's going to work? Do you think that the city LA is made for that? Or like, what's the story with parking?
I don't know. Right now, I don't know what rents to really underwrite. We have some units that are unparked and we rent them. But if you're trying to rent 100 units that are unparked, what's the velocity of that leasing? I think ultimately it will get to that. But right now, I don't know how many residents that want to pay above for newer construction, above 2,000 plus, can not have a car. So it'll be interesting. I saw all these TOC buildings. Most of our TOC buildings are fully parked, but I did see a lot of TOC buildings that don't have parking, and I'm really curious what they're renting for. I don't know.
So for how many units do you have that Like, what's the delta typically that you've seen in your portfolio for unparked versus parked? How much rent difference? Like
So
a
most of our
bedroom
buildings have parking. We just done a lot of ADUs that
Got
have
it.
parking, and that's the ones we rent without parking. And I would say most of them are studios, so $200 to $400 less without parking.
Which is significant if you're doing a 100-unit building, right? And then, what's the velocity of that? How quickly can you get?
They're always harder to lease because they want parking.
Everyone wants, because the city's not New York City, right? We don't have public transit that makes it easy to just hop on the subway or a bus or anything like that, which is, I don't know. I don't know if it's going to work out. I guess we're going to have to see. Whatever incentives, right? If they incentivize it enough for the private markets to develop and make money, they will do it. But on the other side of that, just because they incentivize it doesn't mean the renters are going to be excited about it or what they're willing to pay.
I do know more people that are getting rid of their car, though. So some neighbors that I know are getting rid of their car. My fiance doesn't have a car. Just Ubers everywhere. Yeah, so I'm starting to know people that are in the last 8 years, I have met people that are just like, eh.
Well, with Waymo came to LA, which, have you taken a Waymo?
No, not yet.
I haven't taken one either. Apparently it's like a private thing, but I mean, I've heard good experiences where there's not even a driver in the car.
Yeah, I'd hop on in one.
Right?
Yeah.
And if there's a million Waymos, like, I guess you don't technically need a car if you're just, all right, $6. You don't pay for insurance, gas, all that stuff. It's going to be very interesting to see.
I hope LA does transition to more more easily available public transportation.
That's why I love New York City. I love going there because it's so easy to get around everywhere. And one thing I miss about being there is you get to walk. You just walk. You find yourself 10,000 steps I struggle with getting 10,000 steps. And as someone who's health conscious like us, like you want to try to get out there and do it. I have a hard time doing that in LA because there's not that many opportunities to walk, to do that stuff, which is, we'll see. Okay. We talked about vertical integration. So you guys are your own GC and property manager, and you're growing both of them, and you're doing third-party work from the GP perspective. Why the third-party stuff, and why did you decide to vertically integrate?
Yeah, so, we started vertically integrated from the beginning because we kept getting screwed when we were doing housing. We kept getting screwed by GCs, and we didn't know why there were delays. So we're like, let's just do it ourselves. We're going to be in this market for 50 years, so let's just do it ourselves. So we got our GC license, and then when we first built the first building, we're like, man, this took so much effort. I don't want to give it to a third-party management company manage it. We'll just manage it ourselves. And first, we were just doing it for our buildings. We're just doing construction for our buildings and property management for our buildings. But as we grew and we assembled a pretty badass team, like the GC team we have and the property management team we have, they're rock all-stars. And we're like, all right, we have a little capacity. We're selectively taking on third-party work. So third-party construction, more on the multifamily front. We're helping a friend out right now build a beautiful home in the Hollywood Hills. But our edge is in the multifamily. We've built so many of them. And then on the property management side, if it's a cool owner, a friend, they have buildings in the markets that we already have buildings, we'll talk and we'll manage it for them. We're not trying to explode our third-party work, but if there's synergies there, we know we can save compared to most management companies, the owner's money, because we run it so efficiently, because they're mostly for us and we have the systems as if we're the owner. So we're lean and mean in our property management division.
You take the care of it, which is the biggest complaint I hear from owners is, and I have a bunch of property management friends, and no one loves your building as much as you do typically. But if you have that mindset of, taking care of it like it is yourself and you have the systems in place, then it's not as difficult to just plug another building into the system and be able to provide the same level of service to that, which is super great, I think. If you're going to build anything, really, systematize it, processize it. Is that a word? Anyways, okay. What's the number one cause for development delays?
Pre-going vertical or once you're going vertical?
Let's do both.
I guess it's the pre-going vertical, it's dealing with all the craziness of California and getting your permits.
What do you, so what,
it's approved.
explain a little bit about the craziness of California. What do you mean by that?
So there's this thing called CEQA, California Environmental Quality Act, and if basically anyone can slow down your project, stop your project from getting your entitlements, because they think you're going to cause issues to the environment, which is more traffic, more noise, more pollution, and it's very easy for them to just slow down your project. So I'm not an expert on it. I just know that's why we wanted to stay under 50 units in a lot of our developments, because we didn't want to mess with a CEQA.
So is it if you're under 50 units, you don't have to deal with CEQA?
And you're doing by right, yeah.
Got it. So if you're not doing on menu or off menu incentives, which basically is, there's like a list of things that you can choose to.
If you're going on menu, once you go off menu, then you're
subject to CEQA, which is why I think it's so hard to build, because I was looking at this new plan in 2025, this ordinance, and you literally need a PhD to understand all the nuances of what you can and can't do, what's the feasible, what's not. If you do this, setbacks, trees, parking, like there's so many nuances to it.
Yeah, and then DWP, and then by understanding when the power department, water power, when it's like, what setbacks do they need? How much power do you need? How much street digging do you need to do? How expensive that's going to be? And that usually takes around a year to know. So we're buying these sites sometimes, and it's like, how much is Department of Water Power going to charge us to get this? And it's
hard to tell. You don't even know.
You don't know. We have a good estimate because we built a lot of them, but it's hard to estimate.
That's why it's hard to start in development too, because there's so many nuances to even one site. And typically I remember hearing this a long time ago when I was younger, but a developer typically is shooting for like a 20% return minimum, right, to take on the risk of doing development. And so if the estimates go any which way or in direction, like that can blow up your project completely, which I think, is it 1 in 2 developers go bankrupt or something like that? I think there's just 1 in 3 or 1 in 2, like, if you've developed a property, 1 in 2 have declared bankruptcy. I think, fact check me on that, but I'm pretty sure that's a real stat.
That's not good.
No, but but I mean, like, it tells you how hard it is, how difficult it is to be good at this, and the fact that you guys have been able to be successful is kind of, I mean, you're beating the odds, which is pretty damn good.
Yeah, I like it.
What are some of the lesser known like misconceptions people have about the business?
I think it's we're also dealing with margins. So when people see, a $20-30 million development, it's still, we have debt on them, we have partners on them, so it's still a 20% margin business. It's not a massive margin business. So I would say that's a thing, and then just the length of time it takes to build these. I wish we could go back to a way where it could be more efficient in building these faster.
What do you think is next? Like, what's the future of development in terms of, is it ADUs? Is it something has to change politically? Like, where do you think the future of development goes?
Development's going to stop. Like, all my friends who are developers, they're stopping. They're like, pencils down. We're not breaking ground on we're not doing any new acquisitions to do development. Other than maybe covered land plays, that's what we're looking at. So we can buy something with spitting out good cash flow, and then we can entitle it while it's spitting out good cash flow. Maybe we'll look at deals like that. But development's going to stop, which is going to make rents significantly go up, or condo prices go up on a price per foot. And then might make sense to start developing again. Or also we need maybe rates come down. Hopefully rates come down, and that'll also help with the numbers. But right now, development's just going to be on pause.
It is just because it doesn't make sense.
It does not make sense. As the numbers we looked at earlier, it just does not make sense at all.
So that's why you got to have to find these ancillary businesses in the meantime, because there's not much else you can do.
or just buy existing. I think there's
So you're going into existing stuff.
Oh yeah, we're in escrow to buy an existing building right now.
Really?
Yeah.
Tell me about that. Tell me about that process and what you guys are looking to do.
We bought existing in the past. It wasn't our core strength. Our core strength was doing development, but we bought existing and done some value add. But it just so yeah, we're always looking for new opportunities to buy existing. We're looking for newer construction, so we don't have to deal with a lot of the rent control laws on the older buildings. And yeah, just buy existing. I think right now there's some distress in the market, and there's some good deals out there.
So talk a little bit about that newer construction because of so AB 1482 is a statewide law, which I assume you mean you're trying to buy AB 1482 buildings, which are any buildings in the city of Los Angeles built after 1978. And you have different regulations in terms of how much you can raise the rent versus also substantial renovations and just being able to go through a business plan. So walk me through the business plan. If I had a deal and I just listed it today, like what would that have to look like for you to be interested in it?
Well, we got to be able to get good financing. So there has to be income there.
Which has to be what?
Right now we're looking to at least a 5.
Okay.
At least a 5.
In place 5 cap.
In place 5 cap. And obviously there's juice in the rents where we can increase those rents.
To like 7?
7 would be great.
Okay.
Depends on the location. So the deal we're buying now, we're in escrow to buy now. We actually removed contingencies yesterday.
Okay.
We're going in at a 5.5 in West LA. So it's good location. 2000s built. So it was a good buy. And there's juice on the rents. We can increase the rents.
Give me this is going to come out after you close. So like give me more details on the deal, how you looked at it, why it seemed juicy, like go into as much detail as you can.
I don't want to go into much detail
because
don't want to put the broker throw the broker.
Got it. Was it off market?
No, it was on the market. It was on the market, but
you want to pick a different building where I just want to understand, like, from your perspective, because this always fascinates me. So if I, as a broker, am looking to buy a building, right? Like I know, okay, I want to buy a property in this location, this neighborhood, because if I have to hold on to it forever, I'm comfortable owning in that market. I also want to see, okay, if the rents are at $2,000 and market's $3,000, how likely am I to be able to get those rents at $3,000, and how fast am I going to do it, and how much is it going to cost me? So I'm looking at vacancies. I'm looking at quickness of leasing, like how competitive the leasing market is. I'm looking at if I can add an ADU potentially to there, and then I'm buying it. I need it to go in at 5.5. I need to stabilize yield on cost to 7. And then I'm underwriting and predicting that if once it's finished and stabilized, I could sell it at a 6 or 5.75 or something like that. So like that's what I am. If I was to buy a building, that's how I'd look at it. You don't have to give me exactly that deal, but like, give me an example of that, how you think about that.
You broke it down extremely well. That depends on the neighborhood. So if we're west of the 405, we might be able to think we can sell it at a 5.25, 5.5, 5 years from now. But these capital partners, done a bunch of deals with them. They like to hold. So we're just looking at it as a cash flow play. It's like, how fast can we get to high single digits, cash on cash returns? And so that's more we're looking at. But yeah, you got to get the yield on cost as high as possible. That's the most important number that we look at, even for development. What yield on cost are we going to get to once we're execute our business plan?
Yeah, and yield on cost, for those who don't know, is basically like the cap rate after the cost of improvements and everything that goes into it. So like let's say you have a 5 cap and the market rates put it at 7, but you have to put money in to get those higher rents. So it's including the cost associated with that, which is where you get your number after everything. Okay, this is how much our return is.
Yeah, and that's your spread, because if you're selling at a 5.5 5 years from now and you're at a 7, you have 150 bip spread, and that's your profit. That's your developer profit.
Yeah, and ideally, if I think it's a really good time to buy right now, truthfully, because if cap rates compress in the slightest, 25, 50, 100 basis points, which, they were in 2022, we were selling 3 cap deals, which is just crazy. 2021, 2022. Like if you buy a 5 cap and you get it to a 7 and then now you can sell it at a 4, like that's how you get rich as fuck.
Yes.
Like that's the fucking money right there, right? So it's interesting
but who knows, like if it'll ever get to a 4, because I don't know if rates will ever come down that low. But even if you just, let's say cap rates come down by 10% and then NOI growth by 10%, that could be a big number too. So it doesn't have to be such a huge margin. I think just cap rate compression by 10% and NOI growth by 10%, it can get very interesting. And let's say you have interest rates come down by 10%. So that could be a pretty big number.
Yeah, that's where the compounding comes into play. And that's why real estate is feels like a boom or bust, but why people love real estate is because it's all on a multiple, right? And so you don't have to move that much to have a big swing in value, which is good on both. I mean, good and bad on both sides, right? Which is the people who were underwriting, the developers underwriting to a 4.75 or 5 cap exit. And now they come to us and say, hey, what can you sell this new construction for? And I'm like, 5.5, 5.75, depending on the location. And they're like, oh my goodness. Okay, well, I don't think we're going to be selling anytime soon.
I got 2 of those. 2 that we completed last year, and it's like the cost is more than the value. So we spent 4 years grinding away, buying the land, bought it right, built it right. Problem is financing costs increase so much, and on development deals, you're on variable loans. So the interest just shot up like crazy. So now each month you're paying double what you anticipated that you would be paying. So your interest reserve is gone. So now you have to fund the interest reserve. And if there's slowdowns because of COVID delays and supply chain issues, so now the project's taking longer. And now each month it just costs double what you anticipated for longer. And now your cost is just higher than the value of the building.
Jeez, that's why it is not for the faint of heart, development, right? Especially when we saw I don't think anyone could have predicted what we saw happened over the last couple of years, how quickly those interest rates rose. And I mean, a lot of people are feeling the pain, which if you have the capital now, you can take advantage of those distress, especially when the capital partners, I mean, there's some deals in Texas where lenders were, 65% LTV, and the buildings aren't worth 65% of what the person bought it for. Like they can't even sell it at par.
Crazy.
Which is just insane.
And yeah, they overbuilt a little in Texas, so there's a little bit of supply, so rents have gone down from what I've heard, but it's mostly just a capital markets issue.
It's a capital market.
Fundamentals are generally good, especially in LA.
Yeah.
There's still a 95% vacancy here, occupancy. Yeah, so the fundamentals are strong.
So interesting. It's so interesting. I'm curious to know your thoughts with the regulations and rent control. And this is filmed before Prop 33 either passes or doesn't, and it'll come out after. So we're not going to have the answers to this. But with like all the regulations that are going on in California, rent control, things like that, do you see California and Los Angeles as being a long-term place where you want to continue to develop, or do you see yourself trying to diversify and maybe a little more regulation-friendly areas?
So pre-rate hikes, we were starting to look outside of we were starting to look in Texas. Now with the rate hikes, I think we're doubling down on Southern California, not all California, but Southern California. We know the market. We have a competitive advantage here. We have the teams. We have the relationships. And even though sometimes government gets in our way, it affects us one way, but it benefits us other way. Like you were saying earlier, if you own it and there's no supply, rents have to go up and the value of the building is going to be worth more. And if you can build here, which right now doesn't make sense, but it will make sense. It's physically impossible for developers not to be building for more than 5 years. So I think the cycle will return, and we're going to have a competitive advantage to be building here, and the demand will always be there. It was scary for some time during COVID, and we were just, the demographics were just awful for California. like first time in, I don't know, 1800s that California lost people. But I do believe it's so beautiful here. We have a diversified so many industries here. I think people will come back, and that's going to be good for us. That was my only fear. I'm like, are we going to be the next Detroit where everyone just leaves? But I think it's too beautiful that I think the industry will still be strong here. So once people start moving back, which I think I was telling this to a friend, I think we had the perfect storm for the bad in California and in development. We had people leaving because of COVID. It's like, why pay $3,000 rents for one bedrooms when there's no bars, there's no restaurants, there's no sporting events. You couldn't, it was illegal to be outside. It was nonsense. Why pay that? So no, people left. Makes sense. But now that everything's opening up, I think that's they could be the perfect storm for the good, that people start coming back. There's restaurants, there's nightlife, there's entertainment. So how many sports teams do we have in LA?
Oh my gosh.
6, 7.
Yeah.
It's crazy.
1 million.
So people are going to start coming back. So that's going to be good for California, for Southern California. And the second thing is we had crazy rent interest rate going up, and we might see a reversal of that. Maybe not as low as it was, but we'll see a reversal, and that affects us, but then it'll benefit us. So I think we suffered through the perfect storm and the bad, and we might get the perfect storm and the good.
I love to hear that because I agree. I'm long Los Angeles. We'll see after Prop 33, all the internal talk with the brokers. And Prop 33, for those who don't know, is basically getting rid of something called Costa-Hawkins, which it's a statewide rent control law that limits what governments can and can't implement in terms of rent control. And Prop 33 would take that away, which would allow any local city and government to make as strict of rent control as they'd like, which the talk is something called vacancy control, which I'd love to get your opinion on that, because we feel, at least on the brokerage side, and I know a lot of owners, it's like that seems fucking sane to want to cap what you can increase a vacant unit to. If that happens, like, what are your thoughts on that?
I think a key to business, my dad would always say, is you got to be adaptable. So you just got to figure it out. I think it makes more sense for developers if that passes, because now you get to set market rate rents from the beginning. I think the value add game is destroyed. That game, you're just going to let those buildings fall apart, basically. So it's going to be tough. But I think for development, it's going to make sense. I think in New York, the luxury buildings, just the rents shot up.
Yeah, right. Keeps going higher. I know. It's funny when you see, you're like, hey, there's a case study over here, right? New York City. Like, see what's happening, please. Understand it. No, I agree. I think we'll see what happens, but it's going to be quite interesting to, personally, how we have to adjust, because most of the sales we do is value add. And there's not enough developments for us to sell all the time, right? So where does that adjustment go?
I think the key is for developers, if it does happen, you just give 6 months of concessions every new lease.
Right.
So you're always way above
yeah,
what market rate.
Yeah. There's some interesting strategies that people have been talking, and entrepreneurs will always find a way. There's always some sort of, we're naturally drawn to finding loopholes or where arbitrage or where opportunities are to take advantage of some sort of information that is not widely available. So I know that people are resilient. They'll be able to figure it out, but I sure hope it doesn't happen.
Yeah, no, it'll significantly impact it's like when I talk to equity that wants to do invest with sponsors, a lot of them exile California because the political risk is just so high. The demand is great, but just the political risk. They don't want to, they don't know how to underwrite that.
Of the investors and the capital partners and new ones as well who you talk to, what percentage was open to California and what percentage is now no longer even putting California on, if you'd have to guess?
Ever since COVID, so many X'd out California because we couldn't raise rents for years. We couldn't do eviction moratoriums. So many people X'd out California. If I would say a percentage, it used to be from 80% would do California. Now it's maybe 40% will do California. Yeah.
Jeez, man.
But I think it's starting to get better now because of all the supply that got built out of California and not in California.
And people are coming back and realizing that the fundamentals
are strong, but the political risks are
so you got to weigh the options. Yeah. Speaking of resilience, you mentioned earlier, and this is something that's a part of my life, and I know part of you too, is just like working out, fitness, de-stressing. How do you, with all the culminations that go on with development, there's highs, there's lows, business and general, running a business, running different, how do you like decompress / what are the things that you do outside of the office that just is part of your life?
Yeah. Well, I love martial arts, all of them. Mostly I was a decent wrestler, college wrestler. And then after wrestling, I got into Brazilian Jiu-Jitsu, and then that led to boxing and Muay Thai. And I do every Monday night, MMA Monday. So me and some friends at the gym, we just put on the gloves, the shin pads, and we just go at it. And then Tuesday, some no-gi jiu-jitsu. Wednesday, some gi jiu-jitsu. So it just, that when you're in that 1 hour of hard training where you have a grown, smelly meathead of a man trying to punch you, trying to choke you, you forget about all the stresses. It's like, okay, I just got to survive right now. And it's like that level of just pressure you're feeling in that moment where they're trying to punch you or choke you. It's like, okay, and then you get out. It's like, all right, I survived this. Life's not so bad. We're going to survive. We're going to, you feel good after it.
Continue it. I know. It's so important. And I've wanted to get further into martial arts just because of that. So many people I talk to, they're like, there's something, and especially being a male too, I guess, there's that like mammalian, some about being physical that I think allows a lot of the things that we worry about on a day-to-day basis, which really, if you think about it, are not that big of deals. Like most of us has homes and, have food to eat and, family to support and love and stuff like that. But we worry about all these smaller details and can sometimes forget and not be grateful for what we have. And so I think having that physical activity to really kind of put it into perspective and release that shit, like, so important.
Yeah.
So important.
It's just when someone's choking you and you can't breathe and then you are able to get out or you tap out and let's go. It's like, life is so great. I can breathe. Or you're so thirsty because you just train for an hour hard and you drink water, it just tastes so good. Or I used to compete a lot, and it's like when you're cutting all that weight and you finally get to eat, food just tastes so much better. So I think as humans, it's good to put yourself in these uncomfortable positions and puts life into perspective, as you said it.
Yeah, 100%. No, I want to talk to you about that because I know it's a big part, and we've talked about it a bunch. And one of these times I'll get in there and roll with you, but you have to take it easy on me.
Absolutely. That's what I always tell people. If anyone wants to get into jiu-jitsu or any type of martial arts, go with the super advanced, higher belt guys. They have no ego. They're not going to hurt you. It's the beginners that hurt the beginners. So just be careful. If you ever go to a gym, don't go with the beginners because they're spazzy. They can throw an elbow out around. Yeah. Just go with the advanced guys. They'll teach you. They'll know how to control your body where you won't get injured. So that's advice I have. Always give for jiu-jitsu advice.
So I know you don't have kids, but let's say you had kids and you had a child who wanted to start in real estate, right? They're 18 years old or 21 years old, graduated college, whatever. What advice would you tell them to do, and what vertical would you tell them to get into?
I love the brokerage vertical. So I love what you guys do because you guys really understand. You guys understand the deals. You understand what's a good deal, what's a bad deal. And then as a broker, you have so much advantage because you have boots on the ground. You know what's selling and you know when's a good deal. And you can always plug yourself in with an investor or developer and say, hey, I'm bringing you a good deal. I know you're going to make a lot of money. build me into the promote. And that's what we do with some brokers that we consistently work with, is they bring us good deals, we build them into our promote. So not only are they getting their commission, they're participating on the deal with us.
That's interesting. So that incentive, is that something you guys did from the get-go? Because you were brokers, you knew, okay, to get other brokers to send us the deals we want, we need to incentivize them. So let's figure out how we can make it as juicy as possible.
Yeah, let's make it a win-win, because I'm not going to get wealthy out of one deal. I want to do 5, 10, 20 deals. So if I get the first call from the broker, he sends it to me. He knows I'm going to take care of him not only on the commission, but I'm going to get in my promote. I'm going to be the first call. So yes, and as a broker, you have that option because you control the deal. You control the deal. You take it to your client, say, hey, client, I'm calling you, but I want to participate on this deal. And you can work. You can say, I want to figure out how the unit turns work, or I want to be involved. I want to go to the architectural meetings. I want to talk to the GC and see where the costs are being spent. So I think a broker, because you see from the first step, which is the deal, and probably the hardest part is finding the good deal.
And so after, let's say you become a really good broker, after that, what vertical of real estate, whether that be homes, whether that be industrial, whether that be apartments, whether that be development, value add, like after that brokerage, once you get that, what would the then next vertical be that you would go into?
I'm biased. My favorite asset class is multifamily. That's what I know. I've done houses. I would stay away from houses just because of the tax treatments, and it's hard to cash flow houses. So what I always say is like, buy real estate that cash flows. So a lot of people just buy houses. Like, that doesn't cash flow, or most of the time it doesn't cash flow. So buy real estate that cash flows. So I'm biased on multifamily is what I know. Industrial guys are loving life for the last 6-8 years because it's done such a good asset class for them, which makes sense. But I just don't know it so well. I would say multifamily.
Multifamily. Okay. What has been the biggest change that you've had to do over the last 10 years that you think made the biggest impact on business and how you look at things?
Biggest change. That's a good question. Can't think of anything.
It could be like biggest change in your philosophy in terms of investing, maybe a change in the way that you structure your operations, change in the way you think of anything.
Well, one thing, we got our butt kicked on a couple land sites that I had it in that do not do, but we got aggressive. So we bought a couple land sites with leverage, and a thing I had written down, like a company philosophy, is don't leverage land. Don't leverage things that don't cash flow. It's going back to houses. Don't leverage things that don't cash flow was like a philosophy I had learned from the old timers, and they've shared that with me. And we bought a few land sites in the worst time of the market, 2020, 2021. And then we bought it with our own cash. So we were carrying the debt and we were paying for the entitlements. And usually how we did it, we did one at a time. We'd buy it on our own balance sheet. And in the meantime, we'd raise equity. But then when equity froze up because the market shifted, now we had the land sites. And we sold them, but we took a heavy hit. So I'd go back to that philosophy of don't leverage land. I think that's a big learning lesson that I knew, I didn't follow, and now I got to start following again.
What are some other lessons that you've learned from the old timers, your father, people you've seen as mentors? Like, what are some lessons that are like your fundamental pillars of the way you do business?
Yeah, I think just what I said, don't leverage things that don't cash flow. Focus on real estate that cash flows, or businesses that cash flow. So when we started the construction business or the property management, we'd always say, let's grow it with profits. I don't understand those businesses that just don't have profits and keep growing, scaling with no profits. That's too stressful for me. Grow your business with profits. Hire as you need instead of hire first and then hopefully the sales come in and then you need it. And don't get over leveraged.
Yeah. I think those are good lessons that a lot of people need to learn. I myself am a big history guy, so I like to study what very successful people have done and their philosophies. And you notice that there's a lot of similar like lessons or similar sayings, maybe said in a different way. But the way that Charlie Munger thinks, or Warren Buffett, or Andrew Carnegie, or Sam Walton, like there's these very fundamental keys that these very successful people have done, and they try to impart it on a lot of people. And I think people don't look back at history enough to try to understand those lessons and bring them into today. And whenever you can have something like that, where you're like, okay, sometimes I had a mentor of mine said, sometimes people feel better than they listen. And sometimes you have to feel the pain to know that you're not supposed to put your hand on the hot stove. But as much as you can really learn, like, okay, I trust that person. They're very smart. They said, don't put my hand on the stove. I'm not going to put my hand on the stove, right? Those are the things that I think will allow you to really jump ahead of everyone if you're looking to grow into the real estate business, and whatever vertical it is. Take the lessons from, people like yourself, people that you've run across. Ask people questions. There's so much knowledge.
For sure. A simple quote that I love is, success leaves clues. Just see what successful people are doing and just follow, learn, listen. It's so simple.
Yeah. The path has already been, many people have done the path that you want to do. Just like look back and see what they did. And if you do that, there's a great chance you'll be able to get to where you want to go, whatever vision that is. And
it's easy, especially now in California, what we've dealt with through COVID, through the interest rates and commercial real estate, to be a cynic. But I'm a believer that stay positive, stay optimistic, that things will turn, and do not become a cynic. I think that's bad for business.
Yeah, 100%. The last thing I want to talk about before we wrap up, I'm just curious for myself, because I'm a nerd like this. What does your daily routine look like? Like, what time do you get up in the morning? What do you eat for breakfast? Like, what is your energy? Because for me, I just like, how do I maximize or structure my day to feel the best? I'm just curious to know what you do.
So I'm a nerd when it comes to that stuff.
You are?
Too. Yeah, okay. Yeah. So I'm pretty good at, I think the main fundamentals that I do is I'm pretty good about my sleep. So I get 7-8 hours of sleep consistently.
When do you go to bed?
I go to bed around 11 to midnight.
Okay. And so you wake up 7, 8?
Yeah, I'm usually up at 7.
Okay.
And then I skip breakfast. So I kind of don't eat till lunch. So 12 or 1 is usually when I start getting hungry. I'm pretty good about my nutrition on what I get into my body. Try to limit the sugars, limit the carbs, only drink water, don't even drink coffee.
Really? Has that always been the case?
Always been the case. I tried coffee for a bit.
So no caffeine? You don't do tea, anything?
I do tea,
okay,
but not for energy, just for, I hear it's good for you. So I drink tea just because I hear it's good for you. So try to eat pretty healthy. So it's like your nutrients are so important.
What do you eat? Give me like a typical post-fasting lunch and dinner.
Chicken, rice, beans, vegetables. So just plates, like Chipotle. Like, I'm a fan of Chipotle. I'll do a burrito bowl, no rice, just beans, guacamole, veggies, chicken.
So lower carb, higher protein, fiber. Does you grew up in a Hispanic household? Do you still love like the old, national like? Do you?
Mexican food.
I was gonna say, like, do you love Mexican food?
Love Mexican food. Love spicy food, and salsa is not that unhealthy. I don't do sour cream. I limit my cheeses. Yeah, so I'm very good about, so work all day, probably end around 6. Go to the gym, go train 7 to 8:15, done training. Dinner at home, similar diet, so healthy chicken, steak, vegetables. Try to definitely limit carbs before bed. No sugars before bed. And then work a few more hours, go to sleep.
Do you do any sort of like meditation or journaling or mindfulness or anything like that?
Yeah, I try to wake up with a gratitude list, and then I think my training is my meditation.
Yeah.
I try to get into meditation, but I couldn't get into it. My training is where
the gym for me is just like, that's my moment of presence.
You're definitely present.
Right? Yeah.
But I test my hormones and my vitamin levels once a year. So I want to see how I'm aging. And if I'm lacking in something, I'll either supplement in it. So I have a pretty good supplement list. Or I'll change my diet based on what I'm missing.
Has there been any one thing that has given you like the biggest change in either how you feel or perception or mental clarity, or is there anything that you've done specifically where you're like, I would have done that 10 years ago if I could?
No. And I've experimented with a lot. So I've gone pescatarian, I've gone vegetarian, I've done the intermittent fasting, and I feel pretty good. Maybe it's because I'm consistent with I've always worked out in my life. I always eaten pretty clean in my life. So I've tried all these different diets out, and no, I felt the same.
Yeah. Okay. It's very interesting.
I think going back to real estate, it's like the principles is that's what gives you 80-90% of it. It's like, yeah, you can tweak things here and there to maybe a 3-5% improvement, but it's the principles. It's the sleep. It's the hydration. It's the nutrients that you put in your body. It's feeling gratitude, being optimistic. I think that's what's really important.
It's so funny you say that too, because bringing it back into real estate too, when I first started out as a broker, my mentors were like, just do the fundamentals. The fundamentals are 80% of anything you're going to do. Make the calls, do the follow-ups, go on the meetings, do the proposals, and like everything else will find its way out. All the little, drip emails here and this and da, like all these little excess stuff. Sure, it can lead to opportunities, but it's like, if you don't do the fundamentals, if you don't do the basics, the sleep, the nutrition, the calls, the development, if you don't understand the underwriting, the rents, all this stuff, like the fundamentals are so important, and it gets so lost because it's not shiny, it's not chic, it's not something that is exciting. And I think the older I've gotten, the more I've realized that if you just do the fundamentals really fucking well, you will outpace everyone, because most people can't even do the fundamentals consistently.
Yeah, that's the key. Fundamentals consistently.
Paul, thank you very much for being here, man.
Yeah, man.
I appreciate this. This is great.
Yeah.
Thanks. Thank you for listening to this episode. If you enjoyed the podcast, it would mean the world to me if you could rate us 5 stars on YouTube, Spotify, and Apple Podcasts. It really helps us get our name out there and helps us get fantastic people like our guests to share their insights and knowledge with you. Again, my name is Taylor Avakian. I specialize in the sale of apartment buildings in Los Angeles and Southern California, and I look forward to sharing more of these conversations with you. See you in the next one.